What's Grid, Cory?
All right. Well, Grid is a global real estate community. This is built for investors, by investors, right? We don't stand up here. We don't put this on as gurus to pontificate on high. We just look at this as we are real people doing real deals in real time, here to share our knowledge with you, our experiences, and we would hope likewise in return, right? Because we truly believe here that community and collaboration is really what takes everybody to the next level. So that's really the mission behind putting this together, is to connect everyone, learn, collaborate, and build wealth and impact lives through real estate.
Yeah, we firmly believe, right, that real estate is one of the last vehicles to creating wealth that's available to the average American, right? It's one of the few things as you get on this journey where you're going to have access to the same tools that the very wealthy use. And it's something that we can all do. And consistently, if you track a lot of the issues in this country, a lot of the inequality in this country, it's all directly tied to housing, right? So if we expand access to housing, we can solve lots of other problems. It's a very practical thing, right? We want to help you create wealth through housing as well.
That's it.
Yeah.
Definitely, right? So in this room, we really like to welcome investors of all types. Like say, if you've never done this before, great, this is the room to be in, because we are going to take you through a journey over the course of the year, over kind of the life cycle of an investor. And if you've done this 100 times before, excellent, you're also still in the right room, because we want to learn from you just the same.
Yes, teach me your ways. We want to do deals with you. That's why we started this thing.
That's it, 1,000%. So who are we?
Who are we? So Cory and I are both agent investors, and Grid is the largest agent investor-led network in the world. I think we've got
over 40,000 right now.
40,000 investors in the group. There is a national Facebook group. It's not actually as popping as ours. So my name is Justin Myers, and I am a local agent. Started as a young man at the age of 23 as a mortgage broker, and I've been on a journey. I've probably sat in every seat you can sit in real estate, and I never really built wealth. I made money for a lot of other people. So what I'm here is I'm going on a wealth journey myself, right? Because someone asked me, why would you ever give a deal to someone else that you don't participate in? This light bulb went off, right? So that's the journey I'm on here. What I want to do right now, personally, I am looking for city lots. We're doing spec builds. So if anyone has lots in the city, knows where to get them, please talk to me. And you can connect with us. Probably the easiest way I'd say is in our Facebook group, right? Cory, Grid, Knoxville. Mm-hmm. Grid, Knoxville, or just finding us on the socials. Yeah.
Best place to hit you up.
Yeah. Who is Cory? Can I give you the intro, Cory?
Sure.
Cory King. Cory King is one of my favorite people. We've got a shared connection to Florida. Cory's unique in that Cory started from the bottom, now he's here. So he built his way up, came in as a dishwasher in a restaurant, exited as an owner-operator. He can tell you a little about that story, and came in here a few years ago as an agent, right? And just started making cold calls and worked his way up till now. He's got a net worth that's north of $1 million. He's got several properties. His wife's been able to retire. So this is the ghost of Christmas past, the ghost of Christmas future. I can tell you lots of things of what not to do perhaps, and Cory's got a lot of advice on just, hey, here is how, what building wealth step by step at a retail from the bottom up level looks like.
Follow the plan. Stick with it. Pick a plan and roll with it. Thank you for the intro. I really appreciate that. Yes, background certainly comes from a hospitality background. Started in the dishwasher, worked my way up into owner-operator status, bought my first home when I was about 22 years old. Then got into house hacking at the time, right? Which is just having roommates. I don't know, we put a fancy term on it, but I had roommates. That helped offset that income that I was then able to just save and continue just to go back and reinvest in my life. And that's kind of led me to this point now, where we really get to host this community and just learn and give back, and anything I can ever do to help, please don't hesitate to ask.
And this is truly our favorite night of the month. So if there's anyone else here, take a look in the Facebook group. Last thing I want to leave you with is borrow this platform. There's a reason why we put out some marketing that doesn't have our face on this, because here's what I found. When I tell people that I go to an investor meetup or start talking about investors, people automatically assume I'm some kind of expert on investing. I've been asked to speak at investing all around the country, right? Luckily, I'm really good at repeating a lot of information. No, I'm downselling it, but borrow the platform. Get your audience in here. Whatever you are, get them in the room. There's a lot of credibility that comes in here, and there's going to be deals that get made today here. I was just talking to somebody who's got an STR that I want to sell in here. I think I got a buyer for it. So if you're curious about, you don't know how to do that, what that means, get with Cory and I afterwards. We are happy to show you how we hijacked other platforms, because that's the future, right? Social capital is where the future of lead generation is, where you're going to find your audience.
That is the way. Let's talk about y'all.
Yes. It's a smaller room. Do we do a blitz round, or do we do like we did last time?
We could probably get away with blitz round here.
Okay. So here's the thing. Will you help me? Can you give me some feedback? Say yes? Yes. Any more feedback than this, because we have to shout down the talkative people. So if this is really fast, who you are, right? What you do, which should be like a very short answer, and who you need to meet. So my name's Justin. I'm an agent investor. I need people that have lots in the city. Who are you, Cory?
My name is Cory. I'm an agent investor. I'm looking for people with a property to sell because I need my next flip.
Okay. Cory's looking for flips. Awesome. All right. Y'all ready to learn? Cool. Good.
I got some legal stuff.
Yes. Okay. So the state wants you to know this. There's a disclaimer that we sign. As realtors, we are not appraisers, legal experts, investing experts, so put this another way. Investing is a risky venture. Run everything by, right? The state wants us to make that very clear, that all of this advice, you should consult a professional, whether it's tax advice or anything else, right? So we're going to point you in the right direction. Invest at your own risk.
Well said. Cool.
So you found a deal. What's next?
Right? In this, you have a good understanding of what the property is going to cost you, what's going to cost you to renovate it, right? What's it's worth after the fact. You've done all that homework. So now, what? We got to find the money.
Yes.
Right?
So we got a couple of different sources, right? Cash. You want to take cash, Cory?
Absolutely. Cash, right? It's most straightforward. It's the easiest. It's the cheapest. But even if you've got 100% of the money, does it really make sense to tie up all of your money in that one project?
A lot of opportunity cost there, right?
Tons.
What about home equity, stocks, other investments?
Certainly can be some good options in there. You're probably going to you might have to sell or liquidate something that you would otherwise keep in tapping into that, right? Especially when you look at something like a HELOC as well. Very risky venture in there. That's a home equity line of credit. And so I always caution that. They are great tools to be able to use, whether you want to be able to fix up your own property or go and use it as some capital to purchase your next property. Just understand that is tied to a line of credit that's tied to, say, your home, right? So you don't want to over leverage that, because that can come down like a house of cards pretty quick.
IRA, so an individual retirement account. We have a whole other training on how to use a self-directed IRA. This is a great option if you've got enough cash for the entire project, right? You can use that with a loan. Another alternative to this, and Morgan was just talking about this, so he can get with you after. He might talk about it. He's going to a panel later, is if you have a 401k, you can take a loan from your 401k. One advantage of doing investing like this is it doesn't affect your credit and your debt to income ratios the way some of these other deals work, because you're essentially borrowing your own money. So that's certainly an option as well.
Not a bad play.
Friends, family, partner. Cory, tell me the good, the bad, and the ugly.
Well, I mean, certainly there is good opportunities there, right? If you can partner with friends, family, just people that you know, certainly a good option. You're going to get a higher return on your cash that way, because you're partnering with other people in that. Multiple people always adds complexity to it, especially if it's a friend or family member. That can certainly make for some awkward Thanksgivings if things go sideways.
Or just what's the downside? We've done deals together.
Sure.
What's the downside of having more than one person involved?
Less money take home.
Sure.
I mean, really, if you're splitting it 2, 3, 4 ways, it starts to get pretty thin on the return side. That might not make as much sense.
Added complexity. You need to really clearly define roles, who's owning what, right? Because inevitably, if you're making all the decisions together, you can take what is a great asset of doing this together and turn it into a liability. It becomes a drag, right? Because you both have to sign off on everything. And if you're as smart as we are, you both have opinions on everything. When really either person would have been fine either way. But that's I'd say. The biggest one though is just, if you're doing these joint ventures, you're going to give up a lot more than you would if you just found the money independently. So if you're doing those, it's got to make sense where you're both are bringing something equal to the table of non-monetary value, right? Hey, I'm going to go with Anthony. Anthony's got the credit. I have the experience. that would make a lot of sense. But if you're just doing it from a strictly cash basis, you might want to talk to some of the private lenders we talked about today, or some of these mortgage professionals.
Yep.
Which cues us up, loans, Cory.
Yeah, loans, right? So those are just definitely going to cost you more than cash in this whole venture. They're oftentimes, though, the best combination of speed, leverage, cost, and convenience.
So I'm going to pull the audience real fast. Let's go back through these Who has used cash to fund deals before? Anybody? Yeah, I see some hands. Who likes using cash right now in this market to fund their deals? Sean, Steve, not surprising, the money guys, right? I see Zara back there. Okay, great. What about home equity? Anybody fund a deal with the HELOC? Yeah, I know you have. Anybody else? Fantastic. Anybody use an individual retirement account? Greg has? Yeah. 401k? Loans against it? Yeah? Yeah. Fantastic. What about loans? Who's using loans to finance their property? Yeah. Who's using conventional QM loans to fund deals in some capacity? You are? Yeah, I see a couple. Awesome. What about DSCR, debt service credit ratio loans? Yeah? You use those? Yes, yes. All right. What about renovation loans? Anybody using renovation loans to fund some deals? Yeah. I see a couple hands. Any loan products I'm not thinking of? Just straight up. Okay. Just kind of curious to see where the room's at here. A balloon note? It kind of depends on what the originator was. I mean, I imagine it's probably like a commercial property or a non-QM loan. So who uses commercial? Like a private bank? Anybody? I've used those before. Yeah. And then what hard money? Although I think our private money. I've done a lot of those, done deals like that as well. Okay.
Yep.
Cory, let's talk about loans. Let's talk about
just some loan sources.
Yeah. Well, what do you think about using loans for investing? Because some people, just like some people can't find a deal in the MLS, some people don't use lending at all. And I think there's certainly a place for it. Definitely
so. They're a good option. It's a good source of capital at the end of the day, right? Traditionally speaking, it's the most prevalent way to go about, investing in these properties. What are you going to need if you're going to go use financing traditionally? Traditionally, you're going to need a pretty healthy credit score, right? That's probably going to be the biggest foundation of it. You should expect to be bringing 20, 25%, of cash into this deal, right? You're not going to get out. It's just completely for nothing. So you're going to have some skin in the game overall. Generally speaking, that's probably going to cover most of your bases. And you're going to need a track record, right? Yes. To my lenders in here, not always, but if you're going, I've often seen some lenders ask, they want to see, have you successfully done a project like this before? I see a lender nodding, right? And that's maybe more in and Steve said no, but Steve's a hard money guy. So going on the conventional route, you might need to see some sort of a track record. What would they want to see?
Yeah, a lot of lenders, especially if you're doing like a DSCR deal or something like that, want to see you have at least 1 year of experience of owning some sort of investment property. That's not always the case, and there's always an exception in any type of lending. But generally, they want to see some sort of experience with an investment property.
What else do you need to get a bank loan, Cory? Like, what are we going to be looking at? Basic requirements. Tax returns. Okay. Yes. You got to be a verified income, which can be challenging for an investor. Oh yeah, for sure. I mean that, it's going to have to pass an appraisal, right? You're going to pass the appraisal. It's going to have to make sense for the bank to lend on it at the end of the day. So they're going to be underwriting it certainly pretty strictly now in this environment. It's got to pass underwriting just in general, right? Which we know, despite the media hysteria, has underwriting gotten easier or has it gotten a lot tighter over the last 10 years, guys?
Much tighter.
Yeah, much tighter, right? Like this idea that non-qualified buyers are buying homes is a fantasy, right? These are the most qualified buyers we've ever seen. If you look at the credit score right now, it's the highest median credit score I've ever seen, right? And our delinquencies are like less than the lowest they've ever been. So you're going to have to pass through that, and it's going to need a little time, right? What's the fastest you think you can close? Our lenders in here, like realistically, if someone wanted to close a deal, is 3 weeks reasonable?
With TRID, you have to have 10 days.
Yeah.
So, I mean, I've done it. I've done a renovation loan in 20 days, but that was a conventional reno. So.
Yeah, it's a tight turnaround.
Sure.
Yeah.
Which can certainly be a challenge, all this, right? Because if you're looking at, say, possible 3-week turnaround on a conventional loan structure, at times that's not fast enough, right? A lot of these positions or deals you might be buying need to be closed in 7-10 days, 2 weeks on the max. But that's where private money or having cash and liquidity can really help expedite that process.
You can also do delayed financing and just pull your money back out. Like, so if you want to use your own cash to do that quick close, you can do delayed financing, pull your cash out as soon as it closes. So.
Nice. The challenge you're going to find, though, for the deals that we're finding here is many of those rehab deals are not going to be able to be financeable, right? So you're not going to go through a conventional bank unless you're doing like a renovation loan product. We're going to talk about that later because I think it's very underutilized. We had a conversation out before we started Grid here earlier today. What you can also look at is building a relationship with a bank and getting a commercial line of credit, right? That kind of lending off your entire portfolio. I've done those deals before in other ventures that I've been involved with where they're a lot more willing to lend on the ARV. So we've done everything from construction to large scale renovations. That is one product you can look at if you're going down this lending.
Totally.
So let's talk about who likes private money, y'all. Yeah?
Yep. Every hand should be up right now.
Man. This is a quiet crowd. We got more beverages back there. Jesse is bartending back there. If anybody needs one, yes.
Generally speaking, though, right here's one of the pros really with private money in this. These are individuals or specialized companies that are lending out to investors specifically for this purpose, specifically for fix and flip and rental deals. They can be a little bit more expensive than traditional banks when we're talking about like interest rates, things like that, but they can also be a lot more flexible as well. So it's kind of a give and take that you're going to experience going down that path.
Who is lending private money right now in the room? We got Chris Davis, one of our sponsors, will join us later. I see Steve's hand up. I see Greg's hand up. I know Spool mentioned transactional funding. Who's done a deal this year with private money? How was the experience, Don?
Pretty good.
Okay.
Pretty good.
That is a mild endorsement from Don. Jesse.
Jump through hoops. It doesn't matter who you're working with. There's hoops.
Yeah. Jesse, did you raise your hand? Yeah.
Currently doing one with the hard money right now. It's great.
Fantastic. Why did you go? So if you don't know Jesse is a wholesaler. Jesse's also, who are you looking to meet? Some people in the building game. That's where he's headed right now.
I'm looking to get into the building game. I want some more flips.
Yes. But what was that experience like? Why do you like it? Why was it more nimble?
Just, dude, it's easier to get money. Even if it's at a higher percentage rate, it's just so much easier to get a lump sum of money from one person instead of a bunch of different individual people. So it's like the rates are a little bit higher, you get the money and the ease of the money,
So for you, the other option was maybe syndication or something. That'd be easier to go. Fantastic. Yeah. We're actually going to talk about that. Sean is going to talk about syndication with us a little bit here, a little later.
Dive into these a little bit in terms of what these loans are really based on at the end of the day. Oh, Steve.
Just one thing, because I know people tend to confuse the two pieces. There's a very big difference between hard money and private money. The two terms get convoluted all the time. So hard money is still an institutionalized product. Like I've brokered hard money before. I no longer do it because the last 3 deals I tried to hard money broker, I had to close for my clients with my own money in under 3 days to save a deal. So as of the last year, I know there are 1 or 2 companies that still operate okay, but most of the hard money companies on the street have become a lot less efficient at doing what they do. It's still institutionalized and they're still going to have higher, stronger underwriting requirements. They're going to pull credit. They're going to look at bank statements. They're going to look at things that private lenders don't. Like Chris Davis and I have done stuff together. He and I work more similarly. It's legitimate private money where you are the underwriter and you're making the decision, as opposed to hard money where there's actually an institution and an underwriting team. So I just wanted to differentiate it. It's not the same thing.
Thank you. No, I appreciate that. That's a very important distinction. JT.
So are hard money lenders using just that singular asset as collateral, or are they using total liability?
No, the singular asset. Private and hard money will both use asset-based lending.
Okay.
You may have to sign a guarantee as well, a personal guarantee, but generally speaking, the asset itself will secure the property.
Is it more common for the hard money to require a personal guarantee?
Both will usually require somebody to sign.
What we're talking about there is, right, just qualification basis. When you talk about liabilities, your total liability, your total payment. So if you go for conventional financing, right, we know there's debt to income ratios. And if you're looking at some of these investment products as an asset-based product, the same as if we did like a debt service credit ratio, in that case, what we're looking at is the rental income is offsetting that debt to income ratio. Here, these other ones are looking more at the quality of the asset. They're not looking at your total liabilities because you may not make sense on paper, right? They're not looking at my personal liabilities. Does it make sense and do I have an ability to repay?
Yes. Cool. And there, your credit still will be checked, right? You're still going to need to have some capital or collateral to bring to this. If you don't.
Ooh, what do we do then? Did I hear someone say they have transactional funding?
It's certainly that. It's finding a partner or wholesale the deal out, make your cash, raise some capital until you've got enough in the bank to then go about this yourself.
Who's got transactional funding in here? I heard some names.
Transactional, you've got Gator.
What's that?
He's talking about transactional.
No, I'm gonna get to Gator, but I saw someone say transactional too. So you got transactional.
Transactional.
Awesome, Steve. What's the difference between Gator and transactional?
Transactional is more of a double close scenario for a wholesaler.
Yep.
So they can hide the spread and get a deal closed.
And what's Gator funding?
Gator is if you didn't have that down payment, there are people, I know Greg and I have had the conversation, Greg offers that. So where somebody's willing to take a second position at a higher interest rate and provide you the down payment money so that you can then go to the private or hard money lender and get the loan. So now you can bring in your 15 or 20% down and legitimately get into a deal with nothing.
What are you using for collateral there then?
Well, so the lender, the first position lender is collateralized by the property.
Right.
The second position lender has their ass in the wind to a degree.
So why is that?
Okay.
Why is that important? Why are you in a room, right? Because the reason I'm in this room is it's trust transference. There's a lot of people I have a high level of trust for in this room. So when they introduce me to somebody else, right, I can kind of check what their track record is. They've got a reputation. They work with people that I've known for a decade. This is where the fact that we are such a small town works really well. This is where we talk about partnership. Come here, network, talk to other people. There are a lot of people in this room that could come in. Cory and I were just talking about a deal if we wanted to take it down, or are we going to bring somebody else in to put up the 10%? Because we don't want to put our money out there for a flip that we're looking at. So that's where you can partner. That can work a lot of different ways. We can talk about that. Is there anybody in here that has some money that might be interested? If I found a deal and I couldn't close this and I needed a down payment, anybody interested in a potential partnership?
What kind of ranges are you talking about?
Just hypothetically, or just whatever that down payment might be. Is anybody open to a partnership conversation that we'd have after? Cool. Look around. Those are the people you want to talk to. Yes.
1,000%.
You asked if anybody would be interested. She's interested.
Oh, fantastic. Dawn.
Can we go back to the transactional funding? How does that work? How do they get paid? How do they make their money?
I'm going to come back to that in the question section when we have the panel up here. It's a great question.
That's a good one. Morgan.
With a little bit of preparation, I actually really like personal loans for getting down payment money. Like Amex, give me a 6%, $35,000, right? And as long as I deposit that in an account that sits for 2 months, it's invisible to underwrite. They never see that bank statement where it came in. They can say I've got a loan for it, right? But as long as I manage my debt to income ratio, it's unsecured money. I can tell them to go to hell, I think, if it came down to it.
If you are sitting in the audience with a notebook, I'd write that one down. That's a great tip.
Can you say that one more time?
Yep.
Sorry about that. No, I like personal loans for getting down payment money.
Yeah, but then you said Amex, so that's
American Express. Yeah. So if you're an American Express card
property, they'll just like loan you
For the sake of the camera, for everyone at home. So what Morgan just said is you can go take out a loan through American Express for $35,000 at a 6% interest rate or a credit union. And if you season that for 2 months, it's going to be invisible to underwriting. So if you're prepared and thinking what you're going to do, you can source your own Gator funds, you source your own down payment there.
What do you mean by season it for 2 months?
let it sit in an account.
But not that account?
So like an asset.
Underwriting doesn't have to see the deposit, they need to go loan for down.
Yeah, they'll see, it'll be like a loan and then another loan on the property.
Hey, guys, for the sake of just moving forward, right? Yes, grab it afterwards, but it's hard. It's very hard to follow at home. Like no one can kind of tell like who's having a side conversation. It doesn't get picked up by the mics.
Great topic for on the day and just for discussions. You got this many like loan
and right
officers in the room.
afterwards, please grab us for all of this.
Good
We
Lord.
can walk through all that stuff. Let's talk about some hard money loan terms. And keep in mind, Steve is correct. It is very difficult to get these things through underwriting. But we're always going to give you the concept.
Yep. So generally speaking, from an overlay, these are going to be commercial-based loans. These are non-owner occupied. These are not loans that are based on something that you are going to live in. These are two totally separate things altogether. There's RESPA laws. There's all kinds of stuff that comes into play once you're starting to lend on something somebody's going to live in. So these are always based on, these are always investment-based properties that they're holding a first position in, right?
What's a first position? Why is that important?
Because if you screw up, they can take the property. Versus where we just talked about a second position, that guy's kind of hanging out in the wind until the first person gets paid.
First position is first in line to get their money. If we go back to the Great Recession, people that were not in first position did not get any money, right? So what's a typical LTV that you're seeing on those deals? 65 to 70?
Typically speaking, 65 to 70% loan to value ratio on this. Maybe you get 75, but that's probably going to depend more on your relationship than necessarily just a blanket term. If you're going to somebody brand new, I've never done this before, expect to see 65, 70% loan to value is what that loan's going to be.
And if you're dealing with an institution, be prepared to deal with draws, right?
Mm-hmm.
This is going to go whether you do a renovation loan product. It's also, we were talking about the challenge with an FHA 203K is just how onerous it was to have them come out there. And on this project, they're not going to give you all of the money up front. There's going to be some sort of a draw process that you're going to have to meet and fulfill. So just be prepared. You're going to have to deal with that. Mm-hmm. Is credit important?
Yes, but not really. It's like yes and no.
Yes.
It has some impact, not nearly as much because again, these loans are based purely on the asset itself, right? So if the deal is good, if the numbers make sense there, your credit's not going to be as much of a factor as if you were to go down, say, a conventional financing route. And that's one of those good trade-offs with using hard or private money.
So you're going to anticipate on a hard money deal paying points or some prepaid interest at the time of closing because they're going to get paid up front because it's a higher risk deal. You're going to need proof of funds of some kind for the equity in the property, right? They're going to want to see some sort of bank statements, right? Some proof that you got that money. And you're going to need an estimated renovations from a third-party contractor. Like you're going to need someone else to sign off on that. That's something we'll revisit when we talk about renovation loans as well, right? You're going to have to budget in the cost of having a third-party contractor to give you some estimates and potentially be involved in it depending on the product that you use.
Hire GC. It makes life so much better. Just plan on having that additional cost in there in your budget and go with a GC. That's my own personal experience.
And you've got to insure these for all of our wild people that don't insure their investment properties. And if you're not insuring your properties, I'd highly recommend, just think about the liability involved on that property. Like if you're not insured and something happens on that property, I don't know. It's not a risk that I would personally take, although I know a lot of people do. I just look at the long game and I've seen too many things go wrong at this point.
Yeah, I wouldn't expect to get the loan. You're probably going to need to show up at least that day and or before with proof of insurance that you've already provided up front so that they know that on closing that property is insured.
If you structure this correctly, like hard money can be, if you can actually close it. Has anybody successfully closed a hard money loan in the last 6 months? Yes. Awesome. Was it a hard process, Don, or no? Straightforward?
I learned a valuable lesson.
What's the lesson?
I didn't account for them funding 90% of the construction budget. So on top of what I had to put down to get the loan, I'm putting down all the overages. I mean, 10% is assuming your budget's accurate. Well, it's not. So on top of your 10%, you're paying all the overages. So when your GC runs your budget, have him make sure he knows average cost per square foot to build right now in Knoxville and budget accordingly. Don't try to say you're gonna come in cheap when you're really not, because it's gonna screw you as the investor because you pay the difference out of pocket.
Yeah, if you catch that, like we talked about those holdbacks, only 90% of the construction budget, so there's already a shortfall, and then any overage there are coming out of pocket. So if I'm using this to leverage cash, this really starts affecting my cash on cash returns. Things get really tight, may affect me getting other deals as well.
Yeah, and you're prepaying everything before your next draw. So cash flow becomes a real significant issue if you don't have your GC budget realistically.
So the upside to using any kind of leverage here, right, is you can keep more profit if you have this deal structured correctly, and if you do need a partner to bring cash or credit, would we agree it's easier to find $50,000 than $500,000? Yeah. So if I can leverage some other third-party source of funding, it's a lot easier to find someone to come in for a portion of this and not the entire deal.
Yep. Use other people's money, much as possible.
Did you know you can be the bank? Anybody here to learn about, we talked about where to find the money. Anybody interested in learning how to be the bank? Okay.
Absolutely.
Awesome.
This is the end game.
A couple people are interested in being the.
Look at it this way. This is largely the end goal for most people, right? If you don't have to get your hands dirty, I don't have to touch the piece of real estate. I don't have to carry any of the added liability beyond it. And I'm purely lending my own money for a solid rate of return. Why not? That's the smoothest, easiest way to go about all of this. That should be everybody's end goal.
Let me ask this another way. And if you came last time, I will keep asking until I get an answer. Is there anybody that's not interested in eventually being the bank? Does everyone want to be the bank if they had the funds? Yes. Yes. Fantastic. Good. So we're going to talk about how do we get there, begin with the end in mind.
Absolutely.
Do we got Mr. Davis pulled up here?
Is Chris available? Is he on?
Chris. You there, sir?
What's up, guys?
All right. Can we hear you?
I can hear you. Can you hear me?
Yes, we can. Chris is coming from. All right. Chris is coming to us from Fort Lauderdale because when you're the bank, you can work anywhere. So you can zoom in on vacation. This is why you want to be the bank. You're not stuck here in Knoxville watching your property, right, Chris?
Well, I can assure you my girlfriend can attest that I can certainly work on vacation here this week. Yeah, it's good.
How to be a private lender. Chris, who are you and why are you, as you're appearing on this screen for us?
Yeah, I'm a private lender. Thanks to Steve Levine, who's also a fellow private lender, for giving me a shout out. True private lender. I lend my own money. Well, not my money, but our family office's money here locally in Knoxville. Most of our lending is really East Tennessee, Nashville, kind of southeast. But we're really hyper focused in the Knoxville area.
Let's talk about being the bank.
There you go.
Cory, what is private lending?
Yep. So private money, at times aka hard money, right? These are really just when somebody is providing capital, usually in commercial basis, for the purpose of a purchase, renovation, for rental or sale, I guess, of commercial or residential property. But again, these are purely investment-based loans. These are not something that you yourself would live in. It's a totally separate thing altogether.
And so let's talk about this because I love talking about the legal side. There's a reason why this is commercial, right? And there's a couple, these regulations are real. I don't know where Nick is. Nick and I were just talking about this. So he said he saw two different people get in trouble because they bought a home as a private residence, as a primary residence, and then immediately listed it for rent. Okay, that is mortgage fraud. You will get caught. They will call the note. There are consequences. Same here. There are regulations around mortgages. Those regulations don't apply because they're consumer protection regulations in the commercial space. So it's not a traditional residential mortgage loan, right? It's a loan that happens to be secured by real estate, but it is a commercial loan. Why is that important, right? This property can't be owner occupied, okay? And you're not a mortgage originator. Reason you're not a mortgage originator, right, is mortgage originators have a ton of regulation. My mortgage originators here agree, yes, right? So we got to deal with the Mortgage Licensing Act of 2008, which they passed after the last recession. You've got RESPA, you've got the Truth in Lending Act, you've got Dodd-Frank. All of those are regulations that regulate the residential mortgage industry. They are not applicable to you if you're doing private lending in a commercial sense. Does anyone have any questions? Does that make sense? Anyone not having any idea what RESPA or Truth in Lending Act or any of this other stuff is? Cool. Awesome. Everyone knows. The way it was before, just for some context, if you could work underneath the license of an institution. When I started my career, I worked as a mortgage broker for a firm that had over 200 people. Of those 200 people, including the general manager and the supervisors, there were 6 of us in there that had a license, including me. The company was owned by the Gambino crime family. I was working with cell phone salesmen and jewelry salesmen. And because they weren't even licensed, they had no idea of the mistakes and the fraud they were committing. So anyways, there's lots of regulation there. Yes?
I think like the biggest issue is the investor will just call the note due. So unless you have like 300,000, 400,000, like just sitting there to like pay it back, like our mortgage fraud that's one of the biggest deals is like THDA. Like if somebody tries to commit fraud on like a government loan, like they want their down payment paid for, but then they're like, I'm gonna go rent it out. Like THDA has a clause that you have to live in the home 100% of the time. You can never move out or you gotta refinance it. So if you change your address, you send it to somewhere else, they catch wind of it, they'll call the note due. So unless you have the 200,000 to pay for it, I mean, don't do it.
So you're talking about, in that instance, where we first started this off, if you're purchasing it as a primary, committing mortgage fraud, and then I'm going to rent this thing out immediately, your note can get called, just the same as some of the other ones we talked about.
The THDA has a clause in there that at any time that you have a THDA loan, because they're so low rates, like, and they pay for your down payment, like you can never move out of it. You have to refinance it first.
Got it.
And other ones, they'll send I don't live there as my primary residence, they'll send your mail, and if it gets called back or something, like that'll tip the investor off. And I have investors that'll check back in 12 months and make sure you're still living there. Most of them don't, but if they do, like, you better have 200 grand or 300, 400, 500, whatever you paid to pay it off.
Well, about it, me on this number. But I think it's an individual who doesn't have a license. I believe they can still originate 4 owner-occupied a year. That's a threshold that they can do. No? I'm okay. I can be completely wrong about that.
There are certain circumstances in which you can. I won't bore everybody with them.
Yeah, right. The moral of the story is if you have a good enough owner-occupied.
You could hold a note on one house, and then there are certain other things you can.
Yeah, let's not go down. Yes. What you heard me say is don't do this. Yeah. Do not lend on an owner-occupied property. Like that is a very good way to get in very serious trouble, right? You need to lend on investment property. Okay.
Yeah. Have a good attorney on standby. Always consult your attorney for drawing up any of your proper documentation when it comes to this. You are not an originator.
Any thoughts on this, Chris? Got you back on camera, bud.
Yeah,
Unfortunately, sometimes it's a negative. It's one of those unintended consequences things where it'd be nice as a private lender to be able to make that loan to someone who wants to house hack. But the real risk as a lender, it's not that I don't want to make that loan to you. It's that I can't make that loan to you. Otherwise, I'm going to be in trouble.
Most of these things are there for a good reason. There's a reason why we have all this regulation. Mm-hmm. It's because things got insane.
But as an investor, I mean, if you go from being having a loan as a regular consumer, and then you go to an investor loan, you can't assume all those protections are there for you, right? You've got to read the fine print of what you're signing, because it's not like you have Fannie Mae and Freddie Mac looking out for you anymore.
Invest at your own risk. So, when can you consider being a private lender? And Chris, you can jump in. I'll throw you back on the screen if you want to jump in at any point, man. This is our guidelines for when you should start. Cory, what should you do before you jump into the private lending game?
Ideally, you've already done a handful of these deals, right? As yourself, you've either completed some wholesales, you've done some rehab projects of your own. You've got some rental properties. You've just got experience in general, right? You have a good understanding of the business, how this works, how real estate works as a whole, market trends. before we're ever even going down that path where you want to start lending out your own cash. Ideally, you've already been down this path and we're approaching kind of that end goal, that end part of a life cycle of an investor where you're just privately lending cash.
Chris, what do you think? Would you agree?
Well, I do think that it might be at times hyped up more than it actually should be. There's absolutely nothing passive about lending money out. You know, if I stop working today at the beach, in 9 months from now, I have no more loans. I'm making no more money. And so, you know, it's not a passive real estate investment. There's nothing passive about private money lending. You got to constantly be having deal flow. You need a lot of deal flow because most of the deals you see aren't good deals. It's a different side of the game. It's much more of a job than it is of an investment. Does that make sense, Justin?
Yeah, I think we found out this is a recurring theme every time we talk about any topic, right, guys? It's like, oh, you want to wholesale? Lead generation machine. Oh, you want to find off-market deals? Congratulations, your job is driving for dollars. Oh, you lend private money? Congratulations, your job is like acquiring deal flow and you have to go constantly hunt. There's not a lot of truly free money out there. Yeah, I'd agree there. One of the ways you can get started doing this, Cory, we talked about this before on the front of this thing, right, is using a self-directed IRA and lending your own money out through there. And I think I saw Gregory. Is that what you've done before, Gregory?
Yep.
Is that how you got started?
Yeah, and also using a home equity line. So, like you said, it's a little risky, but it's a short-term loan. So, sure. Yeah, the custodian will review all the documents and make sure you're protected and have proper note and deed of trust and everything.
Yeah. So what do you need to know? I want to read these off for you, Chris, and then let you jump back in. Cory, what do you need to know to do these?
So again, you need to be able to how to determine your reasonable after repair value on this, right? Don't expect to be like shoot for the moon and this is going to peak the market and I'm just going to like hit this out. Pick a reasonable, realistic number. Be conservative because anything you can go over that should be a bonus for you. But all of your math should be on a conservative basis, right? You should know how to properly renovate and add value while minimizing your risk. So again, just putting your money in the right places when you're doing that. How to just estimate those rehab costs.
Shameless plug. If you don't know how to estimate rehab costs, go watch our video. I know some people were in the room here from a couple months ago. All those videos are on YouTube. Go to the Grid Investor channel and you can find the Knoxville playlist. We have over 20 videos there. But we'll give you a framework of how to understand these, like what category they're in and what the actual estimated cost is. So you can start looking at this. Definitely, if you don't know this, that is get someone else to come look at a deal with you. Anybody in here that would look at a deal with someone else, give them some feedback on what it might cost to renovate? A couple? A lot of investors don't like networking. Wow.
Absolutely.
I've done this before, and half the hands went up in the room. Yeah, I love looking at deals. Tobias, yes, fantastic. Yeah, I love looking at deals. That's how deal flow comes to me when I show up and network. Yep.
That's it. You should have a good idea as just to how to pull credit, right? And also have a good idea as just how to really restructure these payments and terms. Again, get a good attorney who can help draw this paperwork up for you. But that should be a good framework for you going into it.
Mr. Davis, what did we miss?
You know, you really didn't miss much at all. You really need to be able to know what you're talking about with after repair values and evaluating budgets and finding all the experts around you, attorneys, to make sure you understand the laws that are regulating you. I do pull credit. We soft pull credit, but even that requires certain hoops you have to jump through to be able to do that. But more than anything, you got to be able to really know the market, the real estate market, and that comes with being an investor.
Chris, I know you were a flipper before. Did you like that? Did you enjoy that process?
I did. You know, I still do it on occasion. It's very sexy and cool, especially when I started it. And I was like, man, I'm a house flipper, but I was just terrible at it because I'm incredibly non-confrontational. And you are working with contractors and you better be able to kick some ass at times. And I just didn't have that. So I got steamrolled a lot and just didn't fit my personality. And rentals are better, but Again, I'm a pretty terrible landlord because I'm not confrontational, wasn't good at property management. The lending side just seems to fit my personality a little better.
So if you don't know, if you don't feel confident in all of those, what have you done in the past to get some help, Chris?
Partner with good people. And you got to be really careful with who you partner with, because a good partnership is great, just like a good marriage is great, but a bad partnership is terrible, right? And it is hard to get out of. You just surround yourself with good people. That's what everyone tells you, and it is true.
Yeah, lean on some other people to help you underwrite deals and put some extra eyes on it if you're not sure. I still will ask other people to look at deals sometimes, because why not? If they're around, I'm collaborative. I'm always going to ask.
Hit up your go-to real estate agent if you really need some extra help. Double checking these numbers. I know plenty of agents. I imagine any agent in here, if a private money lender came to you and said, "Hey, will you help underwrite this deal? Will you help run some comps? Will you help me get a good idea on this?" Who here would help out?
There we go.
Boom.
Take a look around. Who's got some questions for Chris?
So, I guess it's for Chris. Do you need to have a certain amount of money to become a private money lender? Could he lend like $10,000 just as well as he could lend $500,000? Like, is there a threshold?
Chris, is there a minimum amount of money that you would need to start lending? Could you lend $10,000 the same as you would lend $500,000? What's the minimum you think you need to get started on that process?
There's just so many areas of lending you could get into. If you have $10,000, you may not be able to do exactly what I'm doing, which is full purchase and remodel financing, even though it is still possible. But someone in the room who would be great to talk to would be Gregory Crane. Shout out to Greg Crane. I think he's kind of in the transactional financing, the gator lending, which I don't understand, but you don't have to have a ton of money to do that. And there's the institutional private money lenders, hard money lenders, I should say, where you could become an employee for them. I hope that answers the question a little bit.
I'm curious, Steve, what's your thought on that? How much, if I wanted to get in the private lending game, how much capital did you feel comfortable before you were able to do that?
So I've actually I lend money for some other people. Mm-hmm. So I have somebody who does it out of their personally directed IRA. I have an ex-partner of mine. I lend about $500,000 of his money. I have somebody that I taught how to lend. I just did it for them. She lends about $110,000. I would say if you have on $100,000, you have a shot at possibly doing one or two small deals a year. It's not going to become a career for you on that. Anything less than that, you are not lending money in this game. And even at $100,000, it's kind of tough because you have to be willing to lend on a property that somebody bought for 70, 80 grand. They're putting down 20%. They only need a small rehab budget, and you're maxed out in one deal. You have all your eggs in that basket. So minimum 100, 125 to do something.
Anybody hearing a theme of partnership come over and over and over again, right? The people at the top don't compete, they collaborate, right? That's why we're really happy to see Steve and Chris and Greg, and they're calling each other out, because I would much rather compete with my friends that I trust to get the business, right? Rather than the unwashed masses.
Yeah.
So let's talk about the loan process real quick.
Sure. Michael had a question.
Michael, yes.
Quick question. Are y'all capped at usury limits, or can y'all have interest rates north of 12%, get into the 15% plus, or are you capped at usury limits?
So the question that Michael has is, are we capped at usury limits? Which, elaborate on usury limits.
So state law in Tennessee is that's the way that I know it, is you can only loan prime plus 4.
Okay.
So Wall Street prime right now is 8.25, which means technically anything above 12.25% would be usury, which means be illegal.
Yeah.
But I know, is there ways around that?
So I want to reiterate, like, I am not an attorney. This is what we're getting into, and check this advice, right? So the question, Chris, I'm curious about this. Are we capped at this? Like Tennessee state law, Michael's saying, is prime plus 4%, which will put us at 12.5%. Is that a cap on what you can lend on?
I've spent an insane amount of money on this question, and the answer is yes, and you can get around it, but you're going to spend a lot of money and you're going to have to jump through a lot of hoops. Or Today it's not that big of an issue because prime has moved up so high. It was a real big issue when prime was 4% lower than it is today, right? Who wants to lend their money at 8.25%? But not many people. So you can get around it. You need a really good attorney. You've got to do a lot of different things to get around it. But in essence, yes, it's certainly doable.
Cool. Yes.
I'm happy to talk more about that, Michael. Just, I don't want to bore everyone in the room with that. So.
Cool. Olivia.
Yes, I actually work with Chris quite a bit on his deals, and he uses one of our in-house attorneys, Andrew. And just another pointer, we have 7 in-house attorneys, so it's always great to just run your questions by them, and they are a resource to utilize.
Yeah, I'm a big believer in paying for professionals. That's why I got a room full of agents and other professionals here, right? Because I like working with really competent professionals, and when I work with really, really good professionals, I always get more than I pay for.
Yeah, well, I was gonna ask Steve, so what do you do if you're under 100K? Like, where would you start?
If we can, I would pivot back to that. No, it's a great question. I'm going to come back to that because I think it's a good one here. I want to run through the rest of these loan considerations, and then I'll make sure we answer that question, if that's all right. Sure. Cory, how does the loan process work? Like, walk us through the step-by-step of how to do this.
Sure. So an attorney is going to draw up a commercial promissory note, which is really just going to lay out all of your terms, the amount you're borrowing, the interest, the repayment schedule, what happens if you default, what's the guarantee on all of that. It's going to be a very straightforward promissory note where you're then going to go sign that, stating that this loan is going to be used as an investment property, right? So you're stating right there that this is not something I'm going to be living in. This is going to be something that I'm using as an investment property. And that the property is the collateral against the repayment. Meaning if I don't pay, they have every right, the same as any other banking institution, to come back and foreclose and take that property from me. And I lose everything I paid out to acquire that deal, any money that I've put into it, etc.
Yeah, so instead of a mortgage here, right, we've got a promissory note, and then we've got I'm going to draw this backwards here. I apparently can't.
Which way are you trying to go?
Right. And a commercial loan agreement.
Yep.
Just the same as any other deal, we got a deed of trust. What does a deed of trust do?
Deed of trust is just guaranteeing that you, or that they have the right, rather they, the lender, the private money lender, have the right to foreclose and take back the property if the loan is not repaid. That's that guarantee that if I default on this, they're going to take it right back from me.
You're going to get a real estate attorney to draft those documents. Olivia's got one. If anyone else has a good one, ask around, right? For the lender, the borrower is going to be responsible for the cost of that. It's typically around $1,000 to get that drawn up. Don't skip this part, guys.
That's a big one. Understand that you are going to be paying for part of that origination of the deal. You're paying for those attorney fees to have that done. And similarly, right, the safety net in this, if this loan is not repaid per those terms, it's the same process as if a bank is going to go through and foreclose it. And as long as the property is worth more than the outstanding loan, they should always get their money back. But if you say started, demoing this out and now this property is in like worse condition, could get a little squirrely.
So here's the risks, right? So the risk here, we're in a very friendly state. If you're an investor, if you're a lender, right? There's less protections than other places. Other states, collection is really impacted by those laws. So, we have grid chapters in Maryland or DC. Those can take longer to foreclose than, let's say, Virginia or Tennessee. Borrowers could file bankruptcy. They can use other tactics to delay repayment or foreclosure. We've seen all of these before, right? I saw somebody they had over 15 properties. They moved to Belize. They got cash for keys in their entire portfolio. Hit all their income, drag that loan process out with the traditional lender like 18 months. So this can add a long time. It's why you want to check credit. Like, do they have a history of not paying their bills? Right? This stuff leaves clues. Typical terms, Chris. We're going to run these by you. Tell us, and you can tell us how you lend as well.
I'm going to go over some quick overviews on this that you're typically going to see, or as a private lender, you might likely structure some of your deals at. So this interest rate is going to be anywhere between, say, 10 and 14%. You're going to expect a couple of points, that 1 to 3 point funding fee. It's about 1% of the loan per point. That's all paid up front in advance. That loan is going to be on that 65 to 70% loan to value ratio, right? Over a 6 to 12 month term. Typically it was like 6 to 9 months, although now it's kind of some recent rule changes in terms of like seasoning periods. I'm seeing some of those loans stretch out to about 12 months now in order for people to actually properly season those properties enough to be able to refinance. Before it was about 6 months, and then now they've changed those rules up to a year. So that's where products, say like a DSCR loan, can help on the refinance piece, because otherwise you now have to season that property or hold it for upwards of 12 months. So 6 to 12 month repayment term on it all. You're going to have some prepayment, some interest up front as part of that funding fee, and really just anything you can negotiate in that as well. So that could be construction holdbacks. So you're not going to get all this cash back, this cash up front. You know, as the investor, you're going to be dishing it out in draws, right? As the renovation project persists.
It could be extension costs. What are the terms if you default? Confessed judgment. Do you use confessed judgment, Steve? No. Personal guarantee. Chris, I'm curious to hear you. You ran through those. What are some of those things? Like what is a confessed judgment or a personal guarantee?
We do personal guarantees on all of the loans where you're buying it in an LLC, because Tennessee's a marital property state. I'm not an attorney. It's one of the two. It's either a non-marital or a marital. But either way, it requires us to have a personal guarantee in place there.
And a confessed judgment is just the same. If you ever filed an agreement where you kind of waive your rights, you have to go to arbitration, you can't sue. It's the same thing here, where if you don't do this, they're able to skip parts of that process and accelerate that judgment. You've already waived some of your rights, and that's why it's a confessed judgment, where they can just go impose that judgment upon you. Any terms? What do you think of those terms we ran through, Chris? Anything that you do differently?
Yeah, I think
kind of
10 to 14% is hit the nail on the head. I'm always 12%. I was 12% last year, which I was kind of on the higher end of the equation, and now I'm on the lower end. I don't raise, I don't lower. As prime goes up, everyone's rates generally go up, especially the hard money lenders, because they're essentially just banks in the end. I charge 3 points. Some people think that's high. I think the point range is generally 1 to 4. The only thing I'll say about this, and that is this is a shameless plug here. When I crafted Approach Lending, my private lending company, I used private money lenders. And one thing I hated is some of the competition will say, we're 10% and we're 1 point. And then you get to the settlement statement and you have like a list of junk fees. And it turns out you're really paying 12% and 4 points or something like that. And so we just try to be really upfront and transparent. Knoxville's a small town. Like, we're 12 and we're 3, and that's what you pay. So that's just obviously plugging my company, but make sure you really watch out for the junk fees with these companies.
I love that.
Are we doing the standing O? Right?
Yes. You also can't see Steve was nodding his head in agreement. I see why you guys get along well, because you're both very straightforward up front, right? Let people know what's going on. Before we move on, anybody have any questions while we still have Chris on there? We've got a couple other things we want to run through really fast. Can we thank Chris for coming out today? JT, yes.
So if you're lending to an entity, do the laws pertaining to liability, is that just treated like how any other business would be treated, like in terms of, like if you have a limited liability corporation, you're lending to them, they have limited liability, but if you were to lend to a sole proprietorship, they have total liability. Is that how you treat it? Or do you have certain ways you treat other entities?
I heard the question there, Justin. I don't treat entities differently. That's an interesting question. I've never run into that, and you should contact a lawyer, because I am not one, and maybe I should as well to get the answer to that.
You got anything to say, Steve?
That's what you're getting a personal guarantee sign.
Yeah.
Either way.
Yeah, that is. So your question was just that there's these limited liability protections, which would protect the borrower in that case, right? From the lender, and then that personal go around that and would basically pierce that LLC to the individual.
So it's like,
yeah, if you sign the personal guarantee, that's the point of the personal guarantee. So a limited liability corporation, just like it sounds, it limits your liability just to that transaction. So if this transaction goes south, hey, sorry guys, we all lost money. We'll again next time. right? But if I'm a lender, no, like you still got that mastercraft boat that's 200 grand and you got this $1 million primary residence. Like, nope, I'm going to need you to personally guarantee that because I'm going to need my money. And that's why we'd have a personal guarantee. I saw some hands go up. Yes, horse.
Which entities do they lend to? Like, I know we just discussed LLC. Do they lend to sole proprietor? Do they lend to what other type of entity?
Yeah, Chris, so the question from Horace is, what entities do you lend to? Would you lend to a sole proprietorship? Would you lend to an LLC? Or is it kind of, you're just going
to individuals of entity you have? I mean, it just depends. If you've got complicated entities that have multiple different owners and companies that own ownership, we just have to get all the information about it. It really doesn't change anything. It's just kind of a pain to go through.
Yeah. Steven.
I'd love to hear a horror story of a time that didn't work and the lessons that you learned from.
My favorite question. Let's talk about failure.
That's one. Yes. Yeah. What happened when it goes sideways?
What has gone sideways? What's been a valuable lesson for you?
You know, I think Steve has been in this business much longer than me, and he's been, you know, on paper we're competition, but he's really mentored me into becoming a better private lender. But he's got more experience. I've never had a default, but I do know that one bad loan can wipe you out, and that's the reason we have personal guarantees and all this stuff. It's not because we're the evil lender. It's because we, in the end, don't really know who you are half the time, and so we've got to protect ourselves. I mean, I've been fortunate, honestly. I don't have a good negative story right now. I'm sure it's coming, but fortunately, not so much right now. Steve, pass it off to Steve. Steve.
Horrible default story. It was the greatest friggin' day of my life.
No, really, as a lender, you don't set out to ever take someone's property. And I'm not going to bore you guys right now with
the process of how foreclosure works. Because you don't actually just get awarded a property. There's a whole process and a bidding and a whole thing.
But I had lent on an RV park in Bristol, Tennessee. And long story short, there was a mess. This is a great story for another time. I don't know if you guys want me to tell a 5 or 8 minute story. You tell me.
You can do it.
Do it. All right.
You got it.
Okay, so I had lent to 2 guys on a property. They bought this RV park. They bought it for 400 grand. I lent them they bought it for 300. I lent them 100. No, 400. I lent them 300. Right.
Hey, Steve, come up here and tell it up here.
Okay.
Yeah.
So we get you on camera. Perfect. Let's see Dalton try it out.
So I had lent 400,000 on this. The purchase price was 400,000. I lent 300,000. They put down 100,000. Now this is why, so everybody understands. I know everybody wants to get in their first deal without any money down. As lenders, if you have any common sense as a lender, you never allow that to happen. And this is why. So they had to come up with their 100 grand. I don't care how they come up with it. I don't care. I don't care if they get it on a credit card. I don't care if they borrow it from their grandmother. It doesn't matter to me. I'm not a bank. I just want to know that they put 100 into the property. So they come up with this, enough money to put down. I lent them the other 300 grand. And they made payments on this RV park. They marketed it. They got it up and running. They did all of these things. What I came to find out is the one guy of the partners that I developed a relationship with, he wasn't a great guy. The other guy was a worse guy than him. The other guy had his name on everything. He was the guarantor on everything. The question you were asking about signing as a personal guarantor. The personal guarantor had just told the other guy that he was cutting him out of the deal totally. Then a week later died of a heart attack. It became an absolute mess. I tried to get in the middle of it. I contacted the guy's family who passed away. I'm like, we need to do something here because now the other guy has no legal recourse and no legal ownership of the property.
He was the one making the payments.
He was the one making the payments, but now it doesn't pay for him to make payments because he doesn't own it. It was all in the other guy's name. It was a mess. So long story longer, I wound up taking it into foreclosure. My attorney wound up standing on the courtroom steps. He put out that you have to put out an ad for like 2 or 3 weeks. My attorney said to me, I love my attorney. Nothing personal against any other attorneys. I just love him, Matt Graves. He said, Steve, do you want to own this or do you want to sell it? I said, I want to own it. So I guess he put out an ad in the smallest newspaper that exists in the world, just to cover his ass, whatever he had to do. And 3 weeks, 3, 4 weeks, 5 weeks, 6 weeks, I guess we were 6 weeks into it, it made it to an auction date. As the lender, I get to run the auction. What that means is I get to set the price, the sell price, and I get to run the bidding. So the rule was somebody has to show up with cash if they want to buy it, and they have to be ready to buy that day. It doesn't mean they have to have a bag of cash, but they have to have a cashier's check ready, however that works. Well, he did such a good job advertising it that nobody showed up. My wife and I were on a road trip. I get a phone call. He's like, Steve, we're 5 minutes from auction and nobody's here. He had to stand on the steps and talk to himself legally, like he's running an auction. You know, do I hear 200? Do I hear 3? So he calls me back like 6 minutes later, goes, you own it. I go, you're kidding me. Now this RV park had to be worth $600,000-$700,000. Within the next 5-6 weeks, there were a few things that transpired. We wound up reselling it for $550, and I still hold a note for $425 on it. That was my horror story. Now, just going back, I know that turned out great, and it's great because you're in a rising market and everything's wonderful. So it turned out, obviously it didn't turn out great for these two guys. One's dead and the other one has nothing now. It turned out good for me. But the reason we always want down payments is that exact reason. Because let's say a market were to drop a little bit, because that can happen. I know most of you people that are newer to this, you've only seen a market go in one direction, like this. You buy something for 100, next week it's worth 120, it's worth 140, it's worth like just keeps going up. But if there's a drop in the market, as a lender, we need some level of protection. If you put down 20%, 15 to 20%, and you've already bought the property right, which a guy like Chris would do, I would do, we help you underwrite. We're not letting you buy something that you're only gonna make 10 or 20 grand on. That's a waste of time for everybody. We'd still be okay, but you as the investor wouldn't. So we would protect you against that also. So we make sure there's plenty of fluff, plenty of money to be made. So although it's not just to make money, it's protection first. So if you're buying a house at 150 grand that needs 50,000 worth of work, that has an ARV of 300, that's a solid deal. If you're buying a house for 150 that needs 50 grand worth of work and it's going to sell for 225, I'm not funding that deal, and I bet you anything Chris isn't funding that deal either. You guys understand that? Or if I'm going too fast with numbers, just tell me. So by doing that, we protect you and we protect ourselves also. Because now if the market were to drop 10 or 20%, which is possible in the next few months, you're not really underwater and we're not really underwater. And you're also in a position where you can't throw your hands up in the air and run because you put 20% and you're gonna fight till that deal is done. You're not gonna leave me holding the bag with an underwater deal. So that's pretty much it.
That's a good story.
Yeah.
Hey, Justin, I got one more too. Just to follow up on that.
Yeah, let's go.
Okay, I had to text my grandfather. He gave me permission. So, I run the kind of residential private lending side of our family office, but the family office does large scale development across the country. And this is applicable to anything. We have a deal gone incredibly bad. I mean, there's going to be no winning in this one. We've got, they're 35-year-olds, 2 of them brothers. They developed apartment complexes and they just had a success after success after success. And so we kept funding them. I mean, they're flying in private jets, all that. Well, recently they stopped paying. And it turns out that they had a bunch of other apartment projects going on with another lender that we didn't know about. And those have gone bad. And so they've been robbing Peter to pay Paul to get those done. And then we caught it. Fortunately, one of our guys in our office was able to catch it one day. And I mean, it's a giant nightmare. You're talking about millions going to be lost here. And I had to ask permission to say this, but there's a really good lesson there is that like, you never know really the story behind what's happening to what else they're doing. I only see the project at hand and what you tell me. And I have instincts to guide me. One of my biggest things, and I'm sure Steve is the same thing, is like, yeah, we look at the asset, but we also have character. Do we get a good feeling of the character of the borrower? And if you're going to get into lending, you need to know that you need to at least believe the person that you're lending to as character. And it's a really good idea to ask the question, and I do this with everyone, what other investment projects do you have going on right now? Not everyone's going to be honest with you, but it's at least a good question to ask.
I love that. Any other questions before we let Chris go? All right, big round of applause. Thank you so much, Chris. All right. For the sake of time, I think I'm gonna run through this fast. You want to skip over?
We can just hit them up real quick.
All right, really fast.
Super speed, right? Let's look at a typical private lending deal. So you got an after repair value of $300,000. You got a purchase price of $175,000. You're ideally looking at about a 6-month timeline between we're going to buy this thing and fix it up and resell it. Rehab estimates, $50,000. Max loan value, $210,000 is what you're going to be loaned out of that. That's 70% of that after repair value. Everybody tracking? Cool. Loan is going to be a 12% interest. This is interest only, so it's going to be $2,100 a month. You're going to be 2 points up front as your funding fee, so it's an extra $4,200. Prepaids going into that as well. 2 months interest, 2 points is $8,400. The total loan funded at closing is $151,600. That's your...
Yeah, so what are we holding back there, Cory? That's the LTV of 70%, 210.
Yep.
Minus our construction holdback.
Rehab.
Right, minus those prepaids.
Minus your prepaids, right. So the total cash to close on that's going to be brought to the table that you're going to need to bring, right, is that $175,000 purchase price minus that $151,000 like loan. So that's $24,000 plus your $4,000 in closing costs is about $28,000 to close that deal. Are you tracking that so far? Cool. So your total cash needed in general out of this whole project to pull this off, you've got that $175,000 plus your $50,000 rehab plus $8,400 in prepaids, $8,400 remaining interest, $4,000 in closing. That's $245,000 total, minus that $210,000 that we started with that we're borrowing. So that leaves you $35,800 you need in cash to be able to pull that deal off. So in this scenario, that borrower's loan costs them about $16,000, and they'll profit about $40,000 after that sale closes. So it's a great increase on your return versus even bringing in like a 50% partner, and the lender earns an annualized rate of return of 16%. So it's a good deal, like all the way around, right? You've got a good chance that they're kind of doubling your cash in 6 months, and the lender's getting a hell of a return as well. Mm-hmm. And if you would continue that, if you were the private lender and you were lending at that rate and just continually lending that money out, that's what Chris talked on earlier, why you got to keep momentum going, because there's a velocity of money here that you're trying to create.
There's a great book, if you haven't read it, The Lifestyle Investor. The Lifestyle Investor by, is it Justin McDonald or is it Donald?
That sounds right, Justin McDonald.
Yeah, take a look at that. It totally changed my mindset around the velocity of capital. Like once you master that concept, it unlocks a lot of things. You can get places a lot faster.
Yep. And if you're going to do that and you were getting your money moving that way, you're doubling your cash about every 4 years.
Any questions? We got a couple people that I wanted to bring up here. They want to learn about some esoteric stuff. We've got a strategy where for all these agents, anyone in there, who doesn't own a primary right now? Anybody else not own a primary residence? Fantastic. We got something for you. Before we jump in there, Sean, Morgan, if you want to come up here. Do we have any questions? Grab them some chairs, bro. Let's get them set up here. Actually, you can put them right there if you want.
Yeah.
You guys can sit right here in the hot seat. Anybody else have some questions? Yes, JT.
What do the terms generally look like for like draws?
That is a great first question. I wouldn't want to speak to that. Steve might speak to that. Like, what are you looking for in terms of draws?
What am I looking for? You.
Like, he's asked. Maybe I'd probably ask Steve that offsite or ask Chris. Like, just what are the detailed terms for draws? And I'm like, that's really going to depend on the project and how they fund it. Good question though. Swap these out.
Yeah, for them to answer questions. Go ahead and just hold on to that. It's cheaper to you.
That's fantastic. Anybody have another question?
Yeah.
Okay. JT, have you done a deal with construction draws before? Okay. You got the book. Fantastic. Basically, there's going to be some sort of parameters you're going to set up front for like what has to get done before they can release those. The challenge sometimes is like funding those with the draws. So it would just be like an acquisition. They might release this much money to get started. You might need to have permits or something pulled to get started there.
Is it like an escrow, or are you just like holding?
So the private money, the lender is holding the money back, and they're giving it to you in spigots. I'm not going to give you $70,000, and then your site work's not even done, right? So you can't get too far out over your skis. Like I'm going to keep track on the project. So that can be pretty flexible. I have done a deal with Steve and it was very just open communication. You know, we needed money, you know, it was, but I've also seen some stuff where it's more formal and you need to like, we're checking off some marks, maybe an inspection process. So it's really going to depend on what you negotiate during the process, if it's private money. Yeah.
Typically speaking, how I've operated it and used it is coming in draws. It's, hey, this first chunk got done, initial demo work got done, and either I might have the capital to go ahead and like pay that, and then I can either submit that invoice to my private money lender, and then I'll just get reimbursed, and or I can try to pass that through, and that'll get paid, right? And you just kind of do that in phases. We got to bring in a GC, like, do yourself the favor, pay the additional difference, like have somebody else there who's going to help you manage this project, and they're going to stay along with it, and they'll help you move that invoicing and everything through.
And we've got a couple project managers, right? So I saw Hunter come in the back, you project manage. Frankie just project managed this project for Cory on 1404 Hannah. There might be some other folks in here, raise your hand if you're looking to do that, but yes, it's a good partnership. So, you know some questions. Let's talk a little bit about, we got a panel really fast here. So we've got Morgan Hardy with Foundation Mortgage, and we've got Sean Thomas. Let's Sean Thompson, all that. I question myself right now. So Sean Thompson. Sean Thompson, I want to let you explain what you do because it's a little unique.
Okay.
We'll get to there. I'll just start with Morgan. We're going to run this thing here. So Morgan is, you know, let's give you guys here. So your mic question or special journal? Fantastic. So we had a conversation earlier. Morgan is a lender. Give us a little bit of your background because you've come a different path. I'm going to just real quick go to your background before you got into your foundation. I know you did a lot of homes.
Yeah. So I came from a call center lender, Loan Depot. They have a consumer direct arm. And I closed a lot of loans. And because of the volume of things I did, I got pretty deep into the rule books, right? So as you can tell, I get into some pretty esoteric topics when it comes to lending. So what I really want to do to grow my career is get into more purchase-focused lending, get it and be able to access more, honestly, complex products that really benefit folks. And yeah, go ahead.
What's that? So for a frame of reference, how many deals did you do?
So in between 2021 and 2022, I personally funded 405 mortgages for a total volume of $285 million. And that is not a scenario where I'm handing off the deal. Every single one of those, I was responsible nape to navel. So if they went bad, I was the one getting in there, fixing them, figuring out what the problems were. And I was really thankful for that background that I actually had to fix these problems, right? I wasn't just taking a call and handing it off. You know, I'm responsible front to back.
So that's what we have Morgan here. If you want to talk, if you got some questions, we get into the nitty gritty of just like, hey, here are some of the investment friendly, like traditional loan products that are out there. And we're going to walk through that life cycle. So we're going to start with, if you don't own a property yet, a purchase money renovation loan is something we should all be looking at. That is probably one of your best advantages. You said there's really only two things we can do right now if you're looking to get in a game if you're new.
Well, actually, you're in an ideal spot if you don't currently have a primary residence and you want to be in this. There are two great roads to go down. One's house hacking. Y'all might have heard that term. We're not talking about it for right now, but it's a cool way to go. It does require you to have roommates, so to speak, just like Cory did. The other is renovation lending. Greatest opportunity in the market right now. We're in a really busy, Knoxville is a hot real estate market. Okay, there's no doubt about that. But still, some of your people don't like ugly houses. But as someone who doesn't have a primary residence, you can put down as little as 3.5% of an ARV price, after repair value price, and own a renovated home. Let me give you a practical example. This is a deal I'm working down in Cleveland, Tennessee. They're under contract for $90,000. They're having $30,000 worth of work done to the property. We're anticipating that they're going to appraise for $170,000. That person is going to make more money closing this loan on their own house than their annual salary is this year. And the only money they've got in the game, they're still able to have down payment assistance. We've got down payment assistance that can be tacked on top of these things because it's primary residence that further reduces your cash outlay. It's only a way to get started. Once you do your first one, that's all you got, right? But you can move. For example, FHA, conventional, every 12 months, you can make a move into a new primary residence and rent out your previous one. So, there's obviously some complications in that, but yeah, your primary residence is a great way to get in motion.
Yeah, so climbing the ladder. So if you're talking to people sometimes and it's like, hey, I want to do arbitrage, or maybe I'm wholesaling, or I'm doing some of those things, like find a primary. Like do that path. Even if you're doing these other paths as well. I've got a great friend of mine. She was nominated for 30 Under 30 Destiny Marshall out in Sioux Falls, South Dakota. But she had, I think it was almost 30 properties by the time she was 27 and a little over 3 years. But she had got 4 or 5 of those just for doing that tactic, right? Of buying one, renting out the primary, and doing it again. So you're running these in parallel to your other acquisition strategies. What's the next step we're going to go along? So that's just that purchase money option. What am I doing? What are some products I can use you for if it's an investment?
Absolutely.
Available in like the regular market.
I've got a zillion different investment products, right? But there is a renovation option. A lot of people don't talk about it because it's a little corner case. 25% down gets you a conventional renovation on investment property loan. Okay. So this is like you're skipping the hard money step in an acquisition and going straight to your permanent financing. Typically about half a point higher than traditional, and there's going to have to be some conversation about legal amounts of fees. A lot of times you're going to have to put in a little bit more down to get to a permissible level of fees on that. But that's another one that's going to let you roll your reno cost into the overall cost of the loan. Okay. One thing I want to be very clear about, reno lending is going to be very hard. It's going to be hard for you. It's going to be hard for me. Okay. So if you're going to do this, you need patience. There's going to be restrictions on the people that you can bring into the process to do the work for you. We can't have Billy Bobs. Okay. These people have to be licensed, insured. They're going to be verified. They're going to have to fill out paperwork. And that's a bigger barrier for some folks in the trades than you might think. I've worked with a lot of really great people, but some people get a little scared of that stuff. It's a barrier, right? But at the same time, the reward is so worth it. One thing I want to be really clear about, that investment property product for renovation is only available on single family, one unit residences.
What questions y'all have? Anything? We'll on the next. See some hands raised. And then, yes.
So you don't have any products for renovation of multifamily or that's...
I'm pretty sure if I dug around, I could turn it up, but this is just something that I'm getting into, and I can turn it up if given enough time. But for right now, I'm just sticking to the devil I know.
Sure, I love that. And then talk to us about. We talked a little bit about this before. Debt service credit ratio loans. It's another product that you can come get from a traditional lender.
Yeah, absolutely. DSCR, perfect product. So conventional, I told you they're going to be hard for me and you, right? Lots of additional paperwork compared to hard money, et cetera. You get a big payoff for it because you get a lower rate, right? And sometimes you'll have to pay the number of points, although that's changing a little bit. You typically be paying points on most conventional investment lending right now anyway. But DSCR avoids all of that paperwork. Once you get north of 5 conventional or 5 mortgages appearing on your credit that are owned by Fannie Mae, Freddie Mac, agencies whatsoever, you start triggering really heavy amounts of money that you have to keep in the bag. Okay. And it becomes extremely difficult to obtain additional finance without having something like a monster 401k or something like that to prove those reserves. But DSCR is going to ignore all your paperwork. It's going to ignore all your other properties, and it's going to care about the cash flow of the asset or the proposed cash flow of the asset. Okay. So if you're purchasing an Airbnb property, depending on the lender that we use, and we do have several that'll do this, we can use the proposed Airbnb income on the property as provided by third-party sites. The property doesn't have to be used for Airbnb at the time, right? But we can use that proposed income to qualify you for that loan. And as long as the proposed amount of revenue meets at least however much the property is going to cost you on payment, you're good to go. It does still check your credit. Reasonable credit is still required. If you're in the mid 6s, you're in the game. Okay. And then obviously you've got to have a significant down payment, and you're typically going to have some level of reserves. I'd say 6 months is usually about a starting point, but it can go as low as 1 month.
And so that's a typical exit strategy. So we talked about private lending. Private lending is not long-term lending, right, Steve?
Correct.
Yes. So once I've done that and I've got my renovations done, how do I exit out of there? Well, it could be a DSCR loan. Or if I'm just getting started, right, I could maybe do a conventional I might be able to get through those and just do a conventional refinance of some kind. Once you get going, as we just discussed, it may be very difficult to do a conventional refinance and pull your money back out because of the limitations you're going to have with the assets you have to hold in reserve. Make sense? Yeah, fantastic. This guy, if you don't know Morgan, is a walking catalog. Go check out his feed. I went back because Morgan did a takedown of, did anybody see that Airbnb collapse hysteria? Yeah. They said that, oh my God, it's going to collapse. 1% of the homes in the market are Airbnbs. Yeah.
Like Arizona, they were talking about like different prices.
Sure, yeah, that we've lost 47% of the market. That guy is a bear. People, not just Jim Cramer makes money like scaring people, right? Controversial views go viral. More importantly, he's proposing that if all of these markets hit, there'd be a forced selling wave and it would tank the economy. No, it would be fantastic if all those properties went. There's no houses for sale. Like, we would just absorb it. Inventory could triple and we'd still be one of the strongest sellers markets of all time. Like, yes.
What's Morgan's speed? You said follow the speed.
Just Morgan Hardy. Morgan Hardy.
Yeah, if you just look up my name on any of the socials, on YouTube, it's Morgan Hardy FM. If you do want to look at that, it's like a 10-minute video. It's not my greatest video ever, but I do a 10-minute video on why that 47% thing was based on completely, honestly, it could be fake data. We're still trying to figure that out, but he's basing it on numbers that aren't even publicly released by the company that he said they're from yet. It's terrible. And I tried to get WBIR to change their story. That's not happened yet, but they need to.
Yes. But also just flagging deals, running through these, like, hey, here's a deal on paper that someone could go after. I've run the numbers. This product's available. Like, great content. Check them out. Sean, I'm going to pass this over to Morgan. I want to ask you some questions. Sean, who are you and what do you do?
I'm moving from single family stuff to multifamily. I'm getting into multifamily syndications.
Awesome. How long have you been investing for?
I have been like a serious investor since 2009.
Awesome. And give us just a short kind of overview for your track record. Like, hey, where are you? How long have you been doing it?
So started out with a single family house in 2009. In 2010, I went to 2 single family houses. In 2011 or 12, I bought my first commercial piece of property, about a little office building, and started getting into flipping houses. Had a partner, and he had all the money, and I did all the sweat equity. We made $12,000 on our first house, made $10,000 on our second house, and lost $65,000 on our third. After that, he lost his appetite, and I don't blame him. So he didn't listen to me. We over improved a house, and some houses in the neighborhood went into foreclosure, and we ended up paying somebody to take we paid somebody out of their 6-month lease in order to take our house. Like, we were just like, take it, please take it. That's an example of where you can get in trouble. Mm-hmm. So all along, I've tried to learn all different kinds of tools that I could put in my toolbox. But I started out, it's kind of a long story, but I started out in 2009 doing my investing, and I was upside down. I owed more than what I was worth. And I went from owing more than what I was worth to having an 8-figure net worth right now. And since 2009.
Yeah. So that's why Sean's up here. I wanted to talk because, on that Grid Facebook group, if you're in there, one of my buddies from Fort Lauderdale, Kevin Kohler, that's involved with our Grid chapter down there, he's one of the leaders with Darnell Ponte, jumped in and he was looking for someone that could backstop a syndication. So walk through, and then Sean jumped in, they got connected. This is another way you can go deploy capital besides just private lending. Walk us through just some of the first off, what is syndication and how did you step in that process?
Well, so let's see, right before the pandemic hit, I had gotten up to about 41 single family houses I was running. I had some office space. I had some flexible warehousing in that kind of space. And I just felt like I was going crazy managing my own deals. And I had a property manager, I had some folks working with me. We were flipping houses, but I just felt like I was responsible for everything. And I keep thinking, there's got to be a better way. There's got to be a better way. So I'm sitting on a dreary, November, beginning of December, sitting in a house, and that guy, Grant Cardone, that everybody's seen, has an advertisement for his training class. I didn't particularly care for Grant at the time. I thought he was like that guy on midnight TV who had the Lamborghinis, the scamster or whatever. But I thought, I know the guy has over $1 billion worth of real estate, and I thought I can learn from anybody. If for nothing else, I can learn from him what the scam is, or try and figure out what the scam is. So I spent 6.5 hours watching Grant one Saturday morning, and it was nasty outside. You know how wet and nasty Knoxville is in December. So I watched him, and he had a deal for $1,000. You could come down to Miami and see his real estate summit, and he'd give you $1,000 investment in one of his multifamily apartment things. I'm like, okay, so I don't see the downside to this. I get to go to Miami in December. I spend $1,000 on a 3-day program. I'm bound to learn something, or meet somebody I can learn something from, and spend part of the winter in Miami. And I get I could write the $1,000 investment off as training, and I get the $1,000 back later on as investment. This is a win-win scenario. So I hollered at my wife. I'm like, how would you like to go to Miami in a couple weeks? So we booked the flight on Allegiant. Allegiant's cheap to go down there. I went down and saw his program. I had bought a 9-unit apartment building, my very first, my first foray into multifamily, little 9-unit apartment building in South Knox. I had looked at a 16-unit, and I couldn't make the numbers work on it because the building wasn't even making enough money to pay for itself, to even cash flow. And so I went in, I started listening to Grant, and the second day he started explaining how you can make $1 million on a 32-unit apartment building by raising all the rents $100. And he went through how commercial, the difference between valuing residential real estate and commercial real estate. And as soon as he explained that, the light come on, and I realized I can make $1 million on that apartment building over at Level Center Drive. I walked out of the meeting. I called the real estate agent. I said, tell that guy I will take that property. I will pay whatever he wants, what he's asking for it. I will close when he wants. I will close at his place. I will take every term that he wants, because that place, every one of those 2-bedroom, 1-bath units over there was renting for $795 a month. And I knew that I could bump them at least to $1,000 or $1,100. So, I got all excited. I got all fired up. I'm like, why didn't I know about this stuff before? So, I bought that property. I raised the rents over there. I gave the people plenty of notice, but they were way, way, way below. I mean, we're talking Farragut that was in $795 a month. This was in 2021. I've owned it just that was the end of 2021 when the beginning of 2021 while that was going on. It took me a little while to get it closed. So I bumped up the rents to $1,300, and I made $1 million net value on that property in about 8 months. So after that, I got hooked. I'm like, okay, so I could keep doing this, and I don't have to get involved with doing everything with a single family. I have bought and sold. I've flipped close to 50 houses now. I've bought and sold about 100 different pieces of property, and I really, really grounded all this. And after my experience with my last partner, it just didn't end well, and I didn't want to go into partnerships. So what I found is the farther and farther up you go, the more professional people are. And then you get situations like how Steve and Chris work together. They may look like competitors, but instead they work together. And what I found is the more professional people that you work with, the more you can grow bigger, faster together than you can, trying to operate on your own. And it's been like a leap of faith. But I found at that level, I'm working with much better quality people than what I was trying to basically worked with before. These were people with like proven track records.
Do we have how to syndicate on the calendar this year, Cory? I know we talked last year. Syndication and stuff like that, right? I have to look at that.
You want me to run through it real quick?
Just real, because I want to get to your part, which is really interesting. So like, what's a syndication, but like in the 30-second part?
Okay. Has anybody ever heard of a syndication? Wonder what it was? All right. I did too. I was like, syndication, that sounds like crime syndicate to me. Like I didn't have a clue what it was. To boil it down, basically a syndication is a group of people get together. They have some folks at the very top called the general partnership that manages a property, and they have limited partners. The limited partners pool all their money together, and they trust the general partners to basically operate a property. And the goal for most of these syndicators is to double somebody's money in 5 years, or get a what they call an annualized rate of return for 15% or better. So it's a pretty good deal. As a limited partner in the deal, it's truly passive. You don't have to do anything, take any calls from no toilets, no tenants, no trouble. Okay. Just put money in. Typically you have to be what they call a sophisticated investor. You can put, $50,000 or $100,000 in, and you get double-digit returns on your money. And that's hard to do with a single family, and you're the one who has to manage it, and there's a whole lot less risk. So I started learning about all this, and I'm like, why would anybody mess around with single family anymore after that? So the way it works is you have the general partners, and the general partners run the deal, but the person who sponsors or leads the deal is what they call the key principal. The key principal is the person or couple people, the group of people that guarantee the loan for the bank. So the key principal has to have a net worth equal to or greater than the amount of money that's borrowed from the bank. So if you're going to go buy a $10 million property and you need to borrow like typically 65 or 70%, you need a $10 million loan. You got to find somebody with at least a $7 million, 70%, $7 million loan. You got to find somebody with at least a $7 million net worth to sign on that deal. And what happened was Justin's friend had a group of people. They found a really good deal on some apartments over in Destin. Anybody heard of Destin? Cool place, huh? Yeah. So over next to Destin is a 120 unit apartment building, and they needed somebody to KP the deal. It was a $17.7 million deal. They needed, there was a loan assumption at 3.46%. Yeah. So they needed somebody to stand in front of that and assume a 9-point-something million loan, and they found me. And we're trying to work out all the details. I'm going to go walk the property Saturday. And so if everything goes right, about 3 months from now, I'll be part owner in 120 units in Destin. So
that's another way, right, to deploy your capital to get a return. I think that's another categorically. I think about that just as a mental model, as another form of private lending, right? I'm backstopping deals, I'm underwriting them. It's the same level of skills. And the theme that we talk about over and over again, it's why we started an investor group, is it's success through others. Like really, there's a lot of great people in this room. Where'd Mark? Did Mark slip out of here? He was just here. We had
Burton?
Yeah. Mark was here. Mark and Charles have an investor meetup. So No Investors Group is going to be next Thursday. Highly recommend you check it out. It's one of my favorite things to go to. They're doing their second anniversary. So if you want to know what's going on in South Knoxville, you will meet all of the South Knoxville movers and shakers. What questions do you have for Sean? Yes, Horace.
Real quick, what are the things that you watch out? I heard one guy said with the syndication, the fine print usually burns the people if the person at top is like a Ponzi type guy. He's collecting all this money, but he really don't know squat about syndication. It's a lot of them are sexist. What would you look out for?
So first of all, syndications are regulated by the Securities and Exchange Commission. Anytime you offer an investment out, that's considered a security. There are bad people who have done this before. They'll only do it one time, because if you screw up, the SEC comes and knocks on your door, and you do not want the feds knocking on your door. Like, they will never do it again. They'll never get approved to do syndication again. There's been bad actors, but there's bad actors in anything. I would never invest with somebody you didn't know, who didn't have a proven track record. So like these things are regulated. They're heavily regulated. Like,
Never attribute to malice what can be explained by incompetence. That's the single biggest issue here. So I saw Robbie had his hand up, and I saw Steven.
So I got a couple questions. So the first one, you mentioned sophisticated investor. Is it similar to being an accredited investor?
okay, so an accredited investor is somebody who makes $250,000 a year per person or $500,000 per couple or has $1 million in net worth. A sophisticated investor is somebody who has maybe done some real estate type stuff and is willing to sign a document that they have read through the what they call the PPM, which is the private placement memorandum. You have read through it and you understand it and you have done real estate transactions before and you are self-identifying as a sophisticated investor.
So just to read the room, who has any questions that are not related to the specifics of syndication, which is in a whole other hour? We'll be here for a couple hours. Anybody have any questions that are not specific? Because Sean's going to be here. Yes.
I have a question about the apartment complex, not the 120 unit, but the other one. So what did you do to raise the rent? Did you renovate the property?
I did not. It was grossly under rented. Now I've since completely renovated 5 units and boosted the rent even further on those 5 units. I did lose almost half of the folks when I gave 90 days notice I was going to raise the rent, but the gentleman who had the property had not raised the rent in 8 years. And you all know what's happened in the past 8 years.
Sure. No, absolutely. Anybody else? JT.
It's about syndication, so
Fantastic. So we'll grab Sean afterwards. Just because really, if we go down that rabbit hole, like we will be here for a long time. Anybody have any other questions? Let me go. Awesome. Thank you, Sean, for being up here. Thank you. All right. Just to wrap up, if you're not on our Facebook group, there's a couple things. So gridknoxville.com. If you're not on our mailing list, we don't have a way to consistently communicate with you, right? You're not going to see every Facebook. Go to gridknoxville.com, put in your email address. We're not going to spam you. I have off-market deals that I need to unload. We've got some events coming up. If you want to sit and talk about syndication, we'll put together another one. I think we're partnering with Dan on this landlord luncheon coming up. Yep. So just go sign up there. If you don't want, to get communication from us, no harm, no foul, but go to there and sign up if you want to get emails from us, find out what deals that are coming up here.
Yep.
So please leave us a review. Please, please, please. Did you get some value out of today? Yeah. Yes. Fantastic.
Cool. Yeah. Definitely leave us a review on Meetup. Leave us a review on Facebook. We also put these on YouTube as well, so please feel free to go there, like it, favorite it, share it with anybody you feel that would find value in this, right? Make sure you RSVP for next month's Meetup. We're going to be diving into all things commercial, right? That's Commercial 101, office, retail, industrial, and storage. Awesome
Anybody
topic.
an Asian in here that'd like to break into commercial? Anybody like to get a check with 2 commas? Yeah? Like, this is a good place to be. I see Tobias back there too. Bring your people that are interested in it. If anybody went last time, somebody told me it was the best investor meetup they ever went to in terms of content and just breaking it down. We're going to give you a very good overview of Commercial 101. We're going to walk through how to understand NOI and give you a basic understanding of asset classes. So you'll be able to have like a foundation to go explore on your own. Yep. Awesome. So,
cool.
Cory, any final requests?
Just go out there. Go do some deals, connect with some people, spread the love. Thank you so much.
Thanks for being in the room.